So you probably remember how to do this. We didn't have an exam on chapter 14 all that long ago. So here we are. This question is asking us to prepare the operating section of the cash flow statement. So you have a balance sheet, 2 years worth, and you have an income statement, 1 year's worth, and you're going to prepare the operating section of the cash flow statement. So not the entire cash flow section, not the entire cash flow statement, just the section on operations. So you got everything you need to do that. And this is one of those things that for sure would be on the exam because we're doing each of the financial statements. So so you know there's going to be those 15 journal entries. You know there's going to be a retained earnings statement. You know there's going to be an income statement. You know there's going to be a balance sheet. You know there's going to be a cash flow, just not the whole thing, just the operations section. And then the other questions, so that's 5 questions, so there's 6 more. So 6 more will just be random other things amongst the stuff that I've showed you. Alright, so cash flow. So I've already put this title on it. I've said cash flow from operating activities. So you know the first thing we start with in operating section is net income. And then we're going to adjust the cash flow to match net income. All right, well, not to match it, but we're going to adjust net income so we come up with the cash flows from operations. All right, so net income, you know, is on the income statement, of course. It's the bottom line. There you go. It's going to be labeled 28.3. Okay, 28.3. Okay. And so next we do our adjustments. So the next thing is a little title that says Adjustments to reconcile net income to net cash provided by operating activities. Ooh, it's a long one. Alright, so now we're going to do our adjustments. The first adjustment is always depreciation expense. It's non-cash, so you add it back in because it was subtracted out, but it's not cash, so you add it back in. So if you have depreciation expense, it's going to be on the income statement because it's an expense. That's where expenses are. 2,100. So depreciation expense 2,100. Okay, so now we're done with the income statement. Now we go to the balance sheet. Now we're going to use the current assets but not cash, right? Because cash is the thing we're adjusting to, right? So it's not like you're going to take the difference in cash, because that's what we're trying to find out. The difference in cash is this, right? Is $5,500. Where did that come from? Right? Well, I mean, it also comes from investing and financing activities, so it's not just from operations, but this difference, where did that come from? So we can't include the difference as part of how we're calculating it. But we do include the changes in accounts receivable, merchandise inventory, any other current assets. So whatever the current assets are, you figure out the differences between them. And was it an increase or a decrease? So for accounts receivable, here's the old year, here's the newer year. It went from 2,500 to 2,000, so it decreased by 500. All right. And merchandise inventory went from 31,400 up to 38,000, so it increased by 6,600. All right. And you're also going to need the current liabilities. All right, that's how they changed. So accounts payable were 8,200. They went up to 9,100. So that's a $900 increase. And accrued liabilities, so accrued liabilities, those are things like taxes payable, salaries payable, interest payable, things you accrue. 12,003 went down to 11,200, so it decreased by 1,100. Okay, so now we've calculated our changes, so we don't worry about anything else. The long term and all that stuff, that is what goes into investing and financing. So, here we go. We've got our changes in operating assets and liabilities. All right, so we're starting with the assets. We've got a decrease in accounts receivable. So when a current asset decreases, you are going to add it, right? So that decrease in account receivable, that's positive, that's an add. We have an increase in merchandise inventory. And that would be negative because it's a decrease in merchandise. Like, think about it, if you have more inventory than you had, cash would have flowed out for you to get it, right? Okay, so that makes sense. Now we're going on to our liabilities. And so we had an increase in accounts payable. Right? And so it's the opposite. Liabilities, current liabilities are the opposite of current assets. So when you have an increase for a current asset, you subtract it. But when you have an increase for a current liability, you add it. So this increase in the liability, we're going to add. All right, and then the next thing was accrued liabilities. We had a decrease, so we subtract. All right, and so we're going to add these all up, and 2,100 plus 500 minus 6,600 plus 900 minus 1,100 equals a negative 4,200. And so that's a negative, right? 2,100 plus 500 is only, 2,600 plus 9, so that would be 3,500. Of course, it's going to be negative, right? And then you subtract those. So negative 4,200, so you subtract that. If these had added up to be a positive number, this would not be negative. This would be an add. In this case, we're subtracting it. 28,300 minus 4,200 is 24,100. And that is what's called net cash flow from operating activities. Be sure you're titling things right. Okay, so the main thing to remember, always add back in depreciation. Start with net income. Always add back depreciation. Expense, not accumulated depreciation. It's entirely possible, like here, see, here's some accumulated depreciation. Don't add that. Then calculate your changes in your current assets and your current liabilities. If an asset increased, if an asset decreased, add it. If it increased, subtract it. If a liability increased, add it. If a liability decreased, subtract it. And then this, depending on how these add up, if this is negative, subtract it. If this is positive, add it. All right, so there you go. That's how you do that.